Kinetic is here to kickstart DeFi and guide the FLR ecosystem into the next stage of explosive growth. We want to inspire you to activate your assets, whether they are traditional ERC-20s issued on FLR or FAssets, and turn their latent potential into progress. Through the tooling provided by Kinetic, you can develop and employ advanced financial strategies with long-term benefits. We are an ecosystem-tailored money market enhanced with an optional work-to-earn element through KISTake, or KeyStake, which it'll have its own native token, and we're going to get into that. This is foundational to the FLR DeFi ecosystem.
Welcome to the DeFi Standard, and this is Mickey B. Fresh.
Kinetic Market, built on the FLR network for its innovative decentralized oracles, operates an algorithmic, non-custodial lending platform. Users idle assets into active strategies, unlocking accelerated financial opportunities. Much like a marble on a track influenced by gravity, setting strategies in motion accelerates financial journeys. Kinetic harnesses the robust infrastructure provided by Rome Blockchain Labs, positioning itself for collaboration with industry leaders. Kinetic will launch on Costin 2, FLR's testnet. Hugo says Rome Blockchain has an incredible pedigree with financial markets on a number of chains, and we're happy they have chosen to build in collaboration with Kinetic on FLR. This is a perfect demonstration of the power of FAssets, enabling decentralized lending and borrowing against these non-smart contract assets like BTC, XRP, and Doge. And they brought into this collaboration Enosis, and we'll talk about it more. Rome Blockchain Labs is the builder behind this Kinetic protocol. And they have battle-tested smart contracts that have proven to run since 2021 on Avalanche's BENQI lending and borrowing protocol, securing billions in assets. Currently, couple hundred million, and DeFi has already begun to explode in the last just couple weeks. So the blockchain for data, FLR, has announced a new partnership with Kinetic, a lending and borrowing platform supported by and built by Rome Blockchain Labs. Kinetic will offer users a seamless platform for participating in DeFi, complete with the potential to earn block rewards using their supplied digital assets. This collaboration will introduce lending and borrowing capabilities essential for deepening liquidity and fostering a robust DeFi ecosystem. When I saw this news, I was happy to see a lending and borrowing protocol as a focal point of FLR partnering FLR Labs directly, because that is a foundational primitive to any DeFi ecosystem. And the reality is, and the truth is, these are network economies, and the Web3 is the value layer on the internet. And like any financial system, you need a financial marketplace, because it is a financial system. That's what DeFi is. I mean, if you want to use the word on-chain finance, fine. But this community, the XRP community, is not aware that this is it. Like, it's going to be more mature and more mature and more mature, and this will dictate the future financial system. Now, is this going to be all the applications ever in blockchain? No, but you need a financial system, and borrowing and lending, to fundamentally support an ecosystem. And Kinetic will offer this seamless platform, and it will allow Flare users to provide assets to the platform and benefit from an incentivized and natural yield through liquidity provisioning. So with borrowing lending protocols, they're similar to liquidity pools, but different. You have a borrower on the borrowing side, a lender on the other side. They both supply collateral, and a lender can also turn into a borrower in the future. So this is something everyone should be aware of and understand, as it will be tailor suited to the Flare network. But if you want to go out further, look into BENQI, BENQI on Avalanche.
Jump in here. From a Kinetic perspective, I think there's a few different steps, in my opinion, of the problems that we're solving. The first one is there's a few fundamental primitives that any ecosystem needs to build a kind of a foundation for DeFi. And those are, of course, lending, swaps, ideally perps, and then some people would argue a few different primitives. But at the very least, you have to get base liquidity in your swap platforms, ideally in a efficient stable swap type platform, and liquidity on lending protocols, to be able to build that composability and have enough liquidity that we can be comfortable with the economic risk. So the first step really is bring to market what we believe to be another iteration on our user experience and the technologies that we put underneath the front end. Of course, are we're excited to launch those as the initial iteration, but the goal there really is just to build that base liquidity. It's like Lego blocks in a lot of ways, and so from our perspective, we want to be that very public, very risk and security focused. Probably not the sexiest protocol at first, just trying to make sure that we're doing things the way that we know works. Beyond that, of course, we plan to launch a few additional products onto Kinetic. We're very excited about FAssets and how that's going to work and open up new vectors of capital efficiency throughout the space. And then, of course, as RWAs and some of these other asset classes continue to proliferate, the seamless multi-chain interoperability from Flare is something we're super excited about. So that's a huge problem we're trying to solve. There's a lot of disparate liquidity, and there's a lot of kind of trapped liquidity in different ecosystems, and that's continuing to happen at a greater and greater pace. And so with a lot of the decentralization and connectivity of Flare, we think we can continue to evolve even with the proliferation of new ecosystems and networks.
Yeah, Diamond, and you mentioned also that you're already deployed on other chains as well. So I'm looking forward to hearing about some of the novel features that are going to be coming or that you can implement on the Flare side of things.
Kinetic gives borrowers access to available assets in an over-collateralized structure with the membership benefits, including interest rebates and a private Discord channel access. Rome Blockchain Labs, RBL, will facilitate the Kinetic launch and produce the technical infrastructure and design. RBL has experience in the creation and deployment of multiple custom financial markets on varying blockchains, including BENQI on Avalanche. And why is that important? Because Flare is built on the underlying architecture is Avalanches, which is a positive thing because it's a multi-chain ecosystem. There's a P chain for validators, C chain for EVM contracts, and then there's an X chain for exchange, but put that aside for now. And then you could have, instead of subnets, which Avalanche has, Flare could have a bunch of constellation networks that connect to the main chain, can be private, can be public, and they must run validators also on the main P chain. The partnership will see Kinetic benefiting from the decentralized price oracles provided by the Flare native FTSO, aka the Flare Time Series Oracle. This integration is key because it will allow Kinetic to acquire off-chain time series data such as cryptocurrency prices without relying on centralized entity or an integration with Chainlink or some other external oracle system, which brings a weak spot to the foundational DeFi primitive. By having native oracle system, you remove that risk completely, and it will become more of a risk in the future because additional integration, it's complex.
Let's move on to Kinetic. How are you guys implementing the FTSO?
Yeah, so great question. We'll be using FTSO as the primary oracle for the lending protocol. It's possible that we may use a backup oracle. Often we do. But in my opinion, and I've been saying this for as long as people will listen, there's two major risk vectors for these ecosystems that are often out of the control of the ecosystem itself. The first one is bridging, and the other one often is price oracles. I mean, as far as exploit vectors go, and Sonic, I'm sure you can talk about this till you're blue in the face, given that you were in the security space before. But as far as risk vectors go and exploit vectors, those are by far the greatest exposure. So anytime we can, and again, if you haven't read the FTSO documents, it was something that we were keenly interested in, and Hugo, thank you for your patience, spent a long time explaining to us the thesis behind it and getting us comfortable with the security. But if you haven't read up on FTSO, please do. We're super excited about, obviously, as Hugo said, the decentralization of the Oracle. That's one of the largest challenges, I think, in the space to date. There's a lot of kind of fine tuning, I think, that the guys at Flare have already been thinking about. Again, just very, very excited about the decentralized nature of FTSO and really what it brings to the table in terms of trust and sophistication. I think we were due for an upgrade from an Oracle perspective, and I'm pretty confident this could be it.
The integration will ensure highly accurate, decentralized, frequently updated, which we just heard that now will be updated every 90 seconds or 60 seconds, I believe, the price feeds. So this is even better. But why is this important? Just quickly. It needs to know the prices because of the protocol needs to constantly manage the positions. If the collateral ratio of a borrower who puts up collateral and they could borrow a different asset. So this is very different from what Flare Finance did with the collateral deposition and issuing a stablecoin. This is more like Compound or Aave, where you could supply any asset, like you could supply FXRP and borrow FLR, or you could supply a stablecoin and borrow another asset, or supply FBTC and borrow FXRP. Like, as long as there's supply on the other side. So the lender just supplies and earns the interest that the borrower pays. In addition, though, there's also going to be a native token with this protocol. And it's going to have we'll talk about it. And they don't go into detail, but it's going to be engineered. And we're going to see more and more of these well-designed economic models that drive user adoption, and they drive a network economy, and they ultimately drive real yield. we're in the stage of accumulation on Flare. We're in beta. This will be launched alongside the FAssets system. But let's talk about the integration of FAssets. FAssets, which are being developed by Flare Labs, enable the non-smart contract tokens with very high market caps like XRP, BTC, and even Doge to engage in DeFi activities. Once these assets are minted as FAssets on Flare, Kinetic's platform will allow them to be used for yield in DeFi. So you think, we're going to mint all these FAssets, well, what are you going to do with it? But what's interesting here is you'll earn other assets. Like you could earn BTFP, you could earn FBTC, you could earn FXRP, you could earn stablecoins. And that's what you want. You want to earn additional assets in real yield because you're providing a service. And the protocol, every Aave and Compound to this day have been proven to be battle tested. BENQI has run flawlessly. And we're seeing, and we're going to talk about more, a plethora of risk analysis and risk management tools like DeFi Radar and DApp Radar, it's called, by Into the Block. And it provides all the parameters and the data to assess the health of a lending system, which is a borrowing and a lending. But what I see, and I'm going to talk more about here, is that this Rome Labs has built multiple other tailored versions. One on EVMOS, which is Cosmos SDK and EVM, similar to the EVM sidechain that's coming to XRP Ledger. They built on Moonriver and Polkadot Counterpart, a lending and borrowing protocol. So the smart contracts are battle tested. That is at the core, and it's the most important thing. But Flare has all these interesting design yield streams natively, and they set it up this way. It's different than Avalanche, and it has reward services. So the cross-chain collateral pool has 20 billion, and it's capped and only a certain amount could come out per month based on a formula. And it's managed by governance. But a reward service can always be added to that by governance at any time to take any percentage of it. Let's take 20% and use that for incentivizing something else. So the same amount would be distributed, but as hopefully Flare's price goes up, you could now, the governance can manage the distribution of the supply, because that's the total supply. So you would have to consider that as a form of distribution. And now theoretically, it will never run out because it will always scale down. But that's not inflation. The inflation rate is on a decline and will be 5% by the time we get to the end of the airdrops, flare drops. So that ends at 36 months. But let me just provide a visual for everybody. And I'm going to say two words that you're going to need to get very familiar with. Liquid staking. The hottest thing, biggest thing, exploding right now, actually, hockey stick in Solana, Avalanche, Ethereum is just on a steady incline of this ability to stake and then utilize the asset. On Flare, in the new white paper, it explicitly says that. I've shown in videos. How that will be done, it just so happens that the BENQI protocol is the one who designed the liquid staked AVAX. Every network is different. Ethereum has like 10 different versions of liquid staked ETH. And that turns into like a mess. You got Binance issuing their version, Lido issuing theirs, Coinbase issuing theirs. Now, Rome is part of an effort to try to, they created an open protocol because institutions who hold these assets they're staking them and they're delegating them. You know why? Because they understand yield. Retail investors, for example, in the XRP community, do not understand yield. They never talk about it. They just think moonshot. That's why you're a retail investor and not a institutional. But we are front-running institutions. But the ones that are here are staking. It's a no-brainer.
On a liquid staking token for FLR to accelerate liquidity in our DeFi ecosystem, as well as balance the decentralization of validators. And I know you touched on this, Hugo, last week. So maybe let's start with JD, and then you can just add your input after. JD, what have you got?
Yeah, that's a really good question. Thank you, whoever posed that. I think there's a few things to think about. I've been a fairly vocal critic of liquidity mining for the last number of years, although we still do it on pretty much every platform that we operate. Until we come up with more capital efficient structures, and I think whoever asked the question is bang on, regardless of the optimized capital efficiency that we're trying to build in right now, it's still generally not enough to create real yield in excess of what the risk premium would be. So as a space, we have to find ways, of course, to raise the potential yields in many cases, and unfortunately, somewhat artificially in the short term, until we have better secondary and tertiary products that really allow us to start to multiply that capital efficiency the same way that fractional reserve banking did for traditional finance. Now, all of that being said, liquid staking, obviously, especially for the FLR asset, is something that we're pretty excited about. Rome Blockchain Labs has a staking platform called Scepter. Again, we built BENQI's liquid staking. We're doing on a few other ecosystems, and assuming the demand is there, we will absolutely do it on Flare, specifically given our experience and understanding of the Avalanche ecosystem, and staking is quite similar here on Flare. So yeah, absolutely, we'll be considering that. We've been talking a lot with the Flare Foundation and core team about, when, how, and what that may look like. So yeah, great question. I think creating real yield, we will be competitive. That's, no matter what the case is, we will be competitive from a yield perspective. We've done this a bunch of times. We have some vendors and partners we work with to help us optimize emissions and so on. But, it's just, it's one of those, I suppose, large challenges in front of us as a space. Now, to that point, where I think we're going to start building in a lot more of this real yield, which can form base yield, is of course liquid staking assets that it creates as close to real yield on chain that you're going to get. You couple that with, a few other composable products, maybe some real world assets, and so on and so forth, and you can really start to build kind of that base yield layer into the system. I don't want to get too deep on how to do that. We've thought a lot about this. Yeah, I think it was a great question.
Very nice. Hugo, do you have anything to add to that?
Yeah, absolutely. I mean, I think I've laid out my thoughts on liquid staking. If executed poorly, it can, destroy the decentralization of the network. I remain to be fully convinced of liquid staking. That said, I think it's an inevitability. It will be built on Flare, so I think the Flare Foundation is taking a fairly, flexible view on liquid staking, with the idea that, if we can partner with the right people, then we can help liquid staking come into existence without it threatening the decentralization of the network, threatening the security of the network as well, which is very important because of the way the network works, specifically our network, not just validators, but the FTSO. So, it's a conversation I know the team have been having with people like JD. Secondly, I think the fears of applications not being used because the staking return on the P chain is high. Let me remind you that the way the structure is built, that essentially the more that is staked on the P chain, the lower the stake return gets, the lower the yield gets. And that is designed, I think, to top out. I think that's designed to be about equivalent with delegation at around 30%. So 30% of the token staked on the P chain. So it's not a problem that exists, ad infinitum. And for many people, the ability to delegate on the C chain and put their tokens that wrapped Flare into an application like a lending protocol, like a DEX, like a Perps protocol, and use it supersedes the benefit of putting it on the P chain. So as the P chain gets fully staked up to that 30% mark, then you've got another 70% of the tokens which really are available for applications. So I wouldn't get nervous about the lack of liquid staking, although I'm as everyone is aware, it's an inevitability.
From banks to DeFi, the evolution of the lending market. Internet of Value, with a full spectrum of DeFi lending enabled, will mean that borrowers and lenders can seamlessly find yield and maximize their economic returns with whatever tokens and assets they wish to hold, without needing to go through any centralized intermediaries. Although there are many esoteric notions with blockchain technology powering the Internet of Value, such as asset tokenization, the concept of yield is more familiar to financial service professionals. Therefore, traditional financial service companies may seek to incorporate DeFi into their offerings sooner than expected. They are already beginning to attract interest from institutional players who have only invested in the traditional financial markets. As things stand, the traditional money market, underpinned by central banks, will not disappear. DeFi faces regulatory and technology maturity issues, and it remains to be seen what will happen when these systems scale. However, with the increased interest in central bank digital currency, CBDCs, development, the conventional money market and DeFi will converge in the foreseeable future. There it is. That is what is to come in the future, this convergence, and it remains to be seen what that will look like. But the foundation of this parallel financial system built on the blockchain and on these infrastructures, which are public layer 1 blockchains, is a borrowing and lending market. That's a foundational structure. And it's a primitive, along with decentralized exchanges is another one. Asset management, derivatives. You'll get the same replication of what's in traditional markets. But the one thing DeFi has that has an advantage over traditional markets is composability, the ability to move from protocol to protocol and where they work together instead of in competition with each other. And that allows for magical things to happen. And assets and what we think of value, instead of just fiat account based, these assets are programmable. So smart contracts can automate the movement of value, and it also could be refactored. The yield can be detached from the asset. NFTs can represent a basket of assets, an index. And if you could bring the data in from off-chain for these assets, you could do some amazing things, especially when it comes to synthetic assets. So we think of tokenization, but there's really three types of tokenizations. There's the regular tokenizing something from the physical world and representing it on the blockchain. And then there's the digitally issuing it of that on the blockchain. Think of a fund or a bond that's digitally native issued on a blockchain. Then there's a synthetic asset, which is a representation that's pegged to the price of an off-chain asset, but backed by on-chain collateral. So you could have a gold synthetic, it's pegged to the price of gold, but collateral is backed by on-chain assets. And with on-chain assets, there is less risk because you don't have to deal with the off-chain. Now, if you have a decentralized oracles and attestation system like FLR does, you can create some really next generation applications. And FLR is built for the future. And with AI and machine learning converging with blockchain in the future, the possibilities are endless of what can be created, and we can't even fathom the applications that will be built in the future. And stablecoins, central bank digital currencies, will all converge with this, and it remains to be seen what that looks like. But this is happening, and it's here now, and it's open and permissionless, and it will remain so. And this is what Web3 and DeFi bring. With the addition of self-sovereign digital identity and zero-knowledge proofs and embedded compliance, it will allow for the institutionalization of DeFi. And that means that the value pours in and gives access to everyone. And that's the future we're headed into. But at this early stage, we are early pioneers at the frontier of a new financial system. But we're going into the second iteration of DeFi. The tooling and the services and the data are getting better. We're going to have a much better user interfaces. And we're going to have more tools to give us a better idea on how to manage the risk. But knowledge and education is the single most important thing on how to maximize the use of these new DeFi protocols that will be a foundation for all types of applications and services to be built on in the future. Not financial advice. I am Mickey B. Fresh, and I am out.
To the Kinetic side, what trends are you seeing in DeFi, and what are you excited about for the future of DeFi?
I prefer to refer to it of late as on-chain finance because I think there's some really interesting iterations of kind of quasi-regulated finance options that are coming on that are still composable with the decentralized options. I think we're going to see a lot of interesting, innovative products in the next little bit. I mean, just speaking of my personal knowledge, there's some insanely brilliant builders right now that are pretty close to coming to market with some really cool products. I think that will actually change the way we view finance, both from a blockchain perspective, but again, from a global perspective. And worth noting that when they won that victory, that was everybody was talking about. XRP as a token has gone up 80-some% since then. I would argue that a lot of that has little to do actually with them winning, although partially. They've made some massive moves globally from a regulation perspective. They've acquired custodians in different jurisdictions. They're really making a move with governments and educational institutions and pretty much anybody from an enterprise perspective. There's some really, really cool stuff, I think, coming down from Ripple.
There's some really, really cool stuff, I think, coming down from Ripple.
And all of the philosophies that we looked at least I looked at when I came over to this space, many of them are still intact. We've always intended to create a better financial system for people globally with greater access, greater opportunity, and democratizing opportunity. And so I think we're really getting to a point actually now where that's starting to become a reality. So some of the trends that I really like globally is we're seeing a heck of a lot more connective tissue with the traditional finance system. This is important, obviously, because until you can operate your entire life on crypto, which surprisingly you can do a lot of, but until then you need a way to get to and from fiat, especially in some of these emerging markets and smaller places. We're seeing groups like XRP and many others acquire custodians and licensing globally to make sure that connective tissue is there. So I'm very excited for this. I think finally we're seeing kind of that holy grail of there's some regulatory clarity that's coming globally. So we're starting to get some ideas on how we can stay in the good books of regulators and continue to build. So that's very exciting. I think we're seeing, like I said, a lot more connectivity with traditional systems globally, which is very exciting. We're seeing a lot of new innovative and sophisticated products all at the same time. And we're now getting, finally, the last piece of the holy grail, in my opinion, is we're finally getting that positive momentum with respect to enterprise and some TradFi interest in participating. I'm a little biased because I really see the future as being one of a hybrid where it's not DeFi versus TradFi and only one wins and the other one must die. I really do think there's a bit of a hybrid reality, and I think we're getting pretty darn close to it. There's a lot of exciting trends from my perspective at the moment.
There's only, a handful of people that can actually, take this through the court system. Again, we've talked about this a lot. Total legal fees, as far as I know, on fairly good authority, is nearing $500 million between Ripple themselves and Brad and other individuals that are also being sued by the SEC. It's crazy, absolutely crazy, how much money they've spent on this. And again, none of us could actually do that. It's worth noting that when they won that victory that was everybody was talking about, XRP as a token has gone up 80-some% since then. I would argue that a lot of that has little to do actually with them winning, although partially. They've made some massive moves globally from a regulation perspective. They've acquired custodians in different jurisdictions. They're really making a move with governments and educational institutions and pretty much anybody from an enterprise perspective. There's some really, really cool stuff, I think, coming down from Ripple.
There's some really, really cool stuff, I think, coming down from Ripple.
So I'm Mickey B. Fresh, and I'm out.
Crypto is our rebellion. It is a rebellion against a system that is unworthy of its authority. It's our rebellion against coercion and servitude. It is our rebellion against the economically ignorant, the endlessly imperious, and the ethically impotent. Crypto is our rebellion against permission, and it is no less than a noble reclamation of dignity and grace as free and sovereign individuals in the service of peaceful civilization. That is why we are here. For the truth is that we don't require permission to build great things from those petty tyrants who build nothing. And this was the very principle on which America was founded. Crypto is a technology of individual freedom and a declaration of financial independence. Crypto is the freedom to act out our own economic interests as free men and free women in a just society. To trade, to exchange, to deal, to build, to barter. We should be optimistic. For what a time to be alive at the dawn of such peaceful revolution, where any two people on Earth can trade value without permission. Does that scare you? Or does that thrill you? The traditional intra-legal financial territory was lost long ago to the political circus. So now we venture into a new territory that we've built extra-legal and permissionless. Here in this new land, west of the old, we admit only a subservience to moral virtue, to mathematics, and to the awesome power of open, composable, immutable code. In our audacity, we build things and force them on no one. And we have invented, not just on the clean whiteboard of imagination, but in the dirty cauldron of real engineering, the world's first and only transparent, objective financial system for all mankind. We built it without $1 of tax money, and we built it without permission. Consider what it means to be in opposition to this development, to be opposed to objective, transparent rule sets and voluntary association among consenting adults, to demand the compliance and submission of peaceful people at the point of a gun. Examine those who act like that, and you will discover where those enemies of humanity so pitifully lay. They are done ignoring us. They're certainly still laughing at us, and they've obviously started to fight us. But we will win, ethical arguments aside, because man is a capitalist creature, and capital flows where it is respected. Like water, it flows where it may. And as the permissions of the fiat system constrain and strangle, so our open, decentralized alternative stands ready to receive it. True innovation is messy, sometimes veering in unhelpful directions and back again. But capital will flow to well-ordered, decentralized finance as water flows indelibly to the sea, and both will happen naturally, and both will happen without permission. Thank you.
you